$500 turned into over $4,000. That's not a typo. And no, I didn't get lucky with some random cryptocurrency. I rode the AI wave through ETFs in the S&P 500. And what happened over the past 2 years completely changed how I think about investing. Let me be clear, right from the start. This wasn't overnight magic. I didn't discover some secret algorithm or insider tip that Wall Street doesn't want you to know about. What I did was pay attention to something massive that was happening right in front of everyone's eyes, and I positioned myself to benefit from it. The artificial intelligence boom wasn't some hidden opportunity. It was loud, obvious, and most people still sat on the sidelines. Here's what actually happened. Back in early 2023, I had $500 that I was ready to invest. Not life-changing money, but enough to matter. I'd been watching the AI space explode with ChatGPT's release, and everyone was talking about how this technology was going to transform everything. The hype was real, but I wasn't about to dump my money into a single stock and pray. Instead, I split my approach. Half went into an S&P 500 index fund, because that's what every sensible investor recommends as a foundation. Boring, steady, reliable. The other half? That went into AI-focused ETFs. This is where things get interesting. The S&P 500 portion was my safety net. Warren Buffett swears by it, and historically, it delivers around 10% annually over the long term. That's solid. That's predictable. But here's what I didn't fully appreciate at the time. The S&P 500 in 2023 and 2024 wasn't your grandfather's index fund anymore. The Magnificent Seven stocks, which include Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, had grown to represent over 30% of the entire index. That's the highest concentration ever recorded. So when I thought I was playing it safe with the S&P 500, I was actually making a massive bet on tech without even realizing it. Meanwhile, my AI ETF position was pure concentrated exposure. I went with the Roundhill Generative AI and Technology ETF. Why that one? It held just 49 stocks, all of them directly involved in building the infrastructure, platforms, and software that power artificial intelligence. No diversification into random sectors. No hedging. Just pure AI. The first few months were honestly pretty boring. My S&P position climbed steadily. Nothing dramatic, just consistent gains that made me feel smart for being responsible. The AI ETF bounced around more, which I expected. Higher potential reward means higher volatility. I checked my portfolio maybe once a week, sometimes less. Then 2024 happened. The S&P 500 absolutely exploded, gaining 23% for the year. That beat virtually every professional forecast. Analysts had predicted modest single-digit growth, maybe 10% if we got lucky. Instead, the index delivered one of its strongest performances in decades. And remember, I mentioned that 30% concentration in tech stocks. Nvidia alone surged 171%. Tesla jumped 63%. These companies were dragging the entire index upward. My boring, safe S&P 500 investment suddenly didn't feel boring at all. But the AI ETF, that was a completely different story. While the S&P 500 was having an incredible year, the Roundhill ETF was doing something that seemed almost impossible. Its top 5 holdings delivered an average return of 56%. The fund itself climbed 47% year-to-date in 2025. And that was on top of massive gains from the previous year. I want to pause here, because this is crucial. A lot of people see those numbers and think it's too good to be true, or that I got incredibly lucky with timing. But look at what was actually happening in the market. Goldman Sachs projected that AI companies would spend over $500 billion on infrastructure in 2026 alone, up from $400 billion in 2025. Private AI investment surpassed $150 billion. The global AI market was exploding from $184 billion in 2024 toward a projected $826 billion by 2030. This wasn't luck. This was a tidal wave of capital flooding into a sector that was fundamentally reshaping technology. The companies inside these ETFs weren't speculative startups hoping to catch lightning in a bottle. They were established players like NVIDIA, Broadcom, Microsoft, and Alphabet. The iShares AI Innovation ETF, which performed similarly to my Roundhill position, had nearly 60% of its assets in information technology, with NVIDIA at 9.5% and Broadcom at 8.8%. These were the companies building the data centers, manufacturing the chips, and creating the software that every other business needed to implement AI. When your customers include every major corporation trying to integrate artificial intelligence, your growth potential becomes enormous. Now, you're probably wondering about the specific math. How does 500 actually become 4,200? Because if you just take the percentages I mentioned and do quick mental math, it doesn't quite add up to an 840% gain. That's an 8.4 times multiple on the initial investment. Here's where my strategy evolved. I didn't just buy and forget. As my positions grew, I rebalanced. When the S&P 500 portion outperformed my expectations in late 2023, I took some profits and moved them into additional AI ETF shares. When the AI ETFs had temporary pullbacks, I added small amounts during those dips. Nothing crazy, just disciplined dollar-cost averaging whenever I had extra cash to invest. This approach meant I was buying more shares when prices dropped and fewer when they spiked. It smoothed out the volatility and lowered my average cost per share over time. ETFs make this strategy incredibly easy because you can buy fractional shares with whatever amount you have available. I also diversified across multiple AI ETFs rather than putting everything into just one fund. The Van Eck Semiconductor ETF gave me exposure to the chip makers across the entire production chain. The Wisdom Tree Artificial Intelligence and Innovation Fund provided a different angle on AI adoption. Spreading across 3 different funds reduced my risk while still maintaining concentrated exposure to the AI boom. The expense ratios on these funds were reasonable, typically between 0.35 and 0.75% annually. That's money you pay for professional management and rebalancing. And honestly, it's worth it. For every $1,000 invested, I was paying somewhere between $350 and $750 per year. Considering the returns, that's negligible. But there's something else happening beneath these numbers that most people miss. Something about how these ETFs are actually structured and what's driving their performance. It's not just about picking the right sectors or timing the market correctly. The real story is about understanding where the money is actually flowing and why certain positions inside these funds are set to explode even further. That's what I figured out about halfway through this journey, and it completely changed my approach. The breakthrough came when I started looking at capital expenditure projections. Goldman Sachs research showed that AI companies would spend over $500 billion on infrastructure in 2026, up from roughly $400 billion in 2025. That's not maintenance spending. That's building the physical backbone of an entirely new technological era. Data centers, servers, networking infrastructure, cooling systems, power distribution. Every single dollar of that capital expenditure flows directly to the companies inside these AI ETFs. When Microsoft or Alphabet announces they're spending $30 billion on AI infrastructure, that money goes to NVIDIA for chips, to Broadcom for networking equipment, to various semiconductor manufacturers for components. The ETFs I owned held all of these suppliers. This realization shifted everything. I wasn't just betting on AI being useful or popular. I was positioned in the companies receiving guaranteed revenue from the largest technology firms in the world. Bank of America estimated that the total addressable market for AI data center systems would reach over $1.2 trillion by 2030. That represents a compound annual growth rate of 38%. AI accelerators alone, the specialized chips that make AI processing possible, represent a $900 billion opportunity. The beauty of ETFs is that you don't need to pick which specific company wins. The Van Eck Semiconductor ETF holds 25 companies across the entire semiconductor value chain, from design to production. If one company stumbles, the others keep performing. The Roundhill ETF concentrated even more aggressively, holding just 49 stocks with the top 5 positions, accounting for 26.7% of the entire portfolio. That concentration meant bigger swings, but it also meant maximum exposure to the clear winners. Here's what people get wrong about timing the market. They think you need to buy at the absolute bottom and sell at the peak. That's nonsense. What matters is identifying a multi-year trend early enough that you can ride the majority of it. I started investing in these AI ETFs in late 2022 and early 2023, right as ChatGPT was making AI mainstream, but before most retail investors understood the infrastructure implications. Was that the perfect bottom? No. Did I miss some earlier gains? Absolutely. But I caught the bulk of a massive wave. The S&P 500 portion of my strategy provided stability during volatile periods. When AI ETFs had rough weeks, my S&P 500 position kept growing steadily. Over the past 2 years, the S&P 500 climbed 53%, marking one of its strongest 2-year performances since the late 90s. That baseline growth meant even my conservative allocation was working hard. The Magnificent Seven stocks, NVIDIA, Apple, Microsoft, Alphabet, Amazon, Meta, and Tesla, drove more than half of the S&P 500 returns during this period. Their combined weighting surged from 21.9% in 2020 to over 30% in 2024, the highest concentration ever recorded. This created an interesting overlap. My AI ETFs held concentrated positions in companies like NVIDIA and Microsoft. My S&P 500 fund also held those same companies, just with lower weighting. Instead of being redundant, this actually smoothed out my returns. When NVIDIA surged 171% in 2024, I benefited from both my AI ETF exposure and my S&P 500 exposure. When other sectors in the S&P 500 had strong quarters, I captured those gains too. But let's address the elephant in the room. Is this sustainable? Are we in an AI bubble that's about to pop? I've thought about this constantly. The difference between this and previous tech bubbles is the revenue. These aren't speculative companies burning cash with promises of future profitability. NVIDIA reported revenue growth that justified its valuation. Microsoft's Azure AI services generated billions in actual revenue. The capital expenditure I mentioned earlier represents real money being spent right now, not hypothetical future spending. Private AI investment surpassed $150 billion in 2025, with a significant pivot toward infrastructure. The market moved beyond hype into the capital-intensive phase of building foundational systems required to scale AI globally. That's not bubble behavior. That's the early stages of a fundamental platform shift, similar to the internet in the late 90s, but with profitable companies leading the charge instead of unprofitable startups. Looking forward, projections show capital expenditure levels will be even higher in 2027. The companies providing hardware are positioned for explosive growth over the next few years. April 2025, projections expect the global AI market to hit $4.8 trillion by 2033. Even if those numbers are optimistic and the actual figure is 30% lower, we're still talking about a multi-trillion-dollar market that's currently a fraction of that size. My $500 turned into $4,200 because I combined patience with strategic rebalancing, diversification across multiple AI ETFs with S&P 500 stability, and early positioning in a sector that was clearly going to see massive capital inflows. The returns weren't luck. They were the result of understanding where the money was flowing and positioning accordingly. Could you replicate this? Absolutely. The same ETFs I used are available to anyone with a brokerage account. The same dollar-cost averaging strategy works regardless of your starting amount. The same capital expenditure trends are still playing out. We're not at the end of this cycle. We're somewhere in the middle innings. The Roundhill Generative AI and Technology ETF gained 47% year-to-date in 2025. The VanEck Semiconductor ETF delivered similar performance. These aren't historical returns from years ago. This is happening right now. The infrastructure build-out is accelerating, not slowing down. Hyperscalers are spending bigger amounts to meet massive data center demand. Chip-making stocks rallied to kick off 2026 because the underlying fundamentals keep strengthening. Start small if you need to. $50 a month into a combination of an S&P 500 ETF and one or two AI-focused ETFs. Let dollar-cost averaging work in your favor. Don't try to time perfect entries. Focus on consistent accumulation during a period when massive capital is flowing into a sector that's reshaping every industry. The companies inside these ETFs aren't going anywhere. They're building the infrastructure that every other business needs. That's how 500 became 4,200. Not through speculation or gambling, but through understanding where the money flows and positioning early enough to ride the wave. The opportunity is still there. The capital expenditure is still accelerating. The market is still growing. Now, you know exactly what's really happening beneath the surface. I'm not suggesting you take your entire savings and dump it into volatile ETFs. But if you're sitting on the sidelines, waiting for the perfect moment, you're already missing it. The infrastructure spending isn't slowing down. The capital isn't drying up. Every quarter, these companies report numbers that justify continued investment. This isn't about chasing hype anymore. It's about recognizing that artificial intelligence requires physical infrastructure, and the companies building that infrastructure are printing money. My $500 became $4,200 because I understood that simple fact before most people did. The same opportunity exists today. The same ETFs are available. The same trends are accelerating. You just need to decide whether you're going to watch it happen or position yourself to benefit from it.